This is Ronnie Velasquez. Thank you for watching this video. The reason I made this video today is because one of the most important things that people ask me when they call me, they want to get qualified for mortgage financing, is what is my interest rate? That is the first thing that they ask me. And I oftentimes say, I don't even know you. I need to know some more information about you to tell you what the interest rate is going to be. See, most people don't realize that we have the best pricing on the market, which is what is quoted on TV. 2%, 2%, 2%. Those commercials, those kind of commercials. Yes, but that doesn't mean that you're going to get that interest rate, because interest rate is based on several factors. So I want to talk to you about a little bit about what factors are involved in calculating interest rate. Now, you have to remember interest rate is based on risk. The risk of a person not repaying back that loan, the risk of a person defaulting on the property. The higher the risk, the higher the interest rate. The lower the risk, the lower the interest rate. So let's begin. Number one, FICO score and credit history. What they want to see is that you have debt and how well you manage your debt. And one of the things that most people have it wrong is I see some people coming to me and they say, oh, I should have perfect FICO score because I don't have any debt. I don't have any credit cards. I don't have any payments. That doesn't mean you're going to have a good FICO score. It's possible, but that doesn't mean you're going to have a good FICO score. And the reason being is because the way the FICO score works is they want to see how much debt you have. Are you paying it on time? How well can you manage your debt? That is the basis on credit history and FICO score, is how well do you manage your debt. That is important. So having no debt, that doesn't mean you're going to have a good FICO. On the other hand, if you have a lot of debt, that doesn't mean you're going to have a bad FICO as long as you manage your debt correctly. Number two, loan program. What type of loan program are you going to get into? Is it going to be a government insured program, for example, FHA or something like VA or a college FA, or is it going to be a Fannie Mae HomePath program or what? Because every program may have different interest rates. I know HomePath, for the most part, has a higher than market interest rate, the same as Platinum program and so on. So depending on the loan program that you're going to get into, is it going to be a purchase, is it going to be a refinance? That's going to depend on what interest rate you get. Number three, zip code of the property. Where is the property located? Is the property located in a declining market? If the property is located in a declining market, is there a chance that the property is going to lose value over the next couple of years? And after it loses value, is there a chance that the borrower is going to default on the property because of loss of value? So they need to look into things like that as well. Number four is approval. What kind of approval did you get from the automated system? Did you get a full approval, or did you get a refer approval? Or did you get a refer with caution approval? Or did you get an expanded approval? See, there's different types of approval, and depending on the type of approval that you get, your interest rate is going to be vary. So the best interest rate that you can get is, of course, with a full approval, the one that says approved, basically. Now, if there's tiers to that, if you get a refer with caution or if you get an expanded approval, then you may be qualifying for the loan, but the interest rate is going to be higher based on that. So that's another thing. The next one is down payment. How much down payment are you bringing into the transaction? Of course, the higher the down payment, the lower the risk. The lower the down payment, the higher the risk, and by definition, your interest rate is going to vary based on down payment as well. So the next one is term. Is it going to be a 15-year mortgage, or is it going to be a 30-year mortgage? Because guess what? The lower the term, the lower the chances that you're going to default on the property during that term, or at least the risk of you defaulting within that period is lower than if you extend it to 30 years, for example. Then the lender will have a longer period in which you may be able to default on the property, if that's going to be the case. So the lower the term, of course, the better the interest rate, the more incentive they have to give you a lower interest rate. The higher the term, the higher the interest rate. So that's another one. Let's say the next one, occupancy. Yes, occupancy is important. Is it going to be owner-occupied, or is it going to be investment property? Because see, the concept is that if it's an owner-occupied property, you have an interest in keeping the property. You want to keep the property even if the property is upside down, or even if you're behind on the payment, you'll still want to keep it. If it's an investment property that is producing no revenue for you, and the property, for example, gets to be upside down or something, then there is no really interest on you in keeping that property because you don't live there, it's not producing any income, the property may be upside down. So those are some of the risks that they have to consider also when it comes to occupancy. Is it going to be owner-occupied, or is it going to be a second home, or is it going to be investment property? And the next one is impound account. When you have an impound account, that means that every month you're sending, with your payment, you're sending the payment for the property taxes and insurance that are due at the end of the period, whether it's at the end of the year or at the end of the period, depending on when you purchase the property. Now, the risk is is that if you don't have an impound account, you are not saving that money that you need to pay at the end of the year, and then the end of the year comes and you don't have sufficient money or sufficient income to pay your property taxes and pay your fire insurance, and that's going to be a problem for the bank, because now they have to put the money to pay the property taxes and insurance, and they're going to have to bill you back or create an impound account and charge you back for the money and try to collect the money from you, and it gets difficult. So that is the other risk that they have when you don't have an impound account. So if you don't have an impound account, chances are your interest rate will be slightly higher than if you do have an impound account. And the next one is investors. Of course, your interest rate will be determined by the investor that you use, and investors, of course, are plenty. You have Bank of America, you have Wells Fargo, you have JP Morgan Chase, you have Flagstar, etc. That's one of the reasons why we work with so many investors, is because we try to get you the best interest rate on the market. As you can see, there is almost between 5, or I would say between 6 to 9 factors that will trigger the interest rate that you get for that particular loan. When somebody quotes you 3% or 4% or 5%, that doesn't mean you're going to get that interest rate. That means that is the lowest interest rate on the market at that moment. You may be able to get it. I'm not saying you're not. Okay, if you meet all the criteria and the risk is low enough, you may be able to get that interest rate. You may even be able to get better interest rates than the next person, right? But it is important for you and for your clients to get pre-qualified and get that good faith estimate that says, based on the information that we gather from you on your income and expenses and your taxes and the amount of money you have in the bank, etc., then you qualify for this much and you qualify with this interest rate. So it is important for everybody to get pre-qualified, so I recommend you that you do it if you haven't, and I recommend your clients to do it right away as soon as they start thinking about looking for a home. If you have any other questions, give me a call, and I gotta tell you, I think it will be an advantage for your clients to either purchase or refinance their homes today. So if you have any questions, give me a call back. Thank you very much for watching, and I'll see you next time. Bye-bye.